a few things here and there. For example, if you are given two organizations, organization A, B, right? Then they have given you a bit. They have given you a bit. They have given you a bit. They have given you here 2,000, 2,000, 2,000, 2,000. And then they have given you debt. Talk of 10% debt, 10% debt. They've given you 10% debt. 10% debt. A is leveraged, 5,000. This is unlevered. This is unlevered. And then they have given you cost of equity. Cost of equity. They have given you a figure of 12% for this. They have given you 12% for that. And then we are required to do something very easy. We are required here to determine value of firm A and B using net income approach. Using the famous net income approach. Using the famous net income approach. Determine the value of A and B using the famous net income approach. So they will give you two firms. It could be like two properties. It could be like two properties and a real estate where they give you property A, property B, and then they want you to give them the value of each property using net income. Using net income approach. Is there anybody who can handle these for us? Who can remember the formula? 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 Yeah, I'll come back to portfolio. You know, as a good teacher, I have to connect my previous session with what I'm going to teach today. If you get a teacher who moves from one topic to the other, just like that, then there is a problem. It's called a recap. Last time I was doing financing decisions, and these are very important. Determine value of A and B using net income approach. Is there anybody who is able to remember the formula? Net income approach. Net income approach. Is there anybody who is able to remember the formula? Great. What they are telling me is that Mwalimu, we know what net income is. We know what net income is. They know net income is profit after taxation. Thank you very much. They know that net income is profit after who? After taxation. They know that net income is profit after who? Profit after tax. And how do we get this profit after tax? How do we get profit after tax? To get profit after tax, we normally take EBIT minus interest. EBIT minus interest. And then, of course, it has to be what here? Adjusted for taxation. It must be adjusted for taxation. Net income is profit after tax. So you take EBIT minus interest. Now, my greatest students, if you can recall, there is a time I told you something very nice about present value when n is infinity. Present value of an amount when n is infinity, we said this one here is amount divided by who? Is there anybody who can remember this? The present value of an amount when n is infinity. Thank you very much, Alice. The present value of an amount when n is infinity, then the present value will be the amount divided by what here, somebody? Amount divided by r. Will be amount divided by r. Will be amount divided by what here? R. Thank you very much. Amount divided by r. If you remember the assumptions of net income approach and the net income, we said that this net income will be received by this company every year indefinitely. Will be received by a company every year indefinitely. We said under net income assumption, first greatest assumption. The greatest assumption on the net income approach is that the firm will be with us for the longest time possible. There is nothing like the going concern of the company being in doubt. So to get present value, we normally take amount divided by what here, somebody divided by R. And because this organization will be with us indefinitely, then to value this, to value the income, to value the farm, using net income approach, we shall take the net income that we have, we divide with what here? We divide with R. R is the required rate of return. And the net income, as somebody tells us, it will be EBIT minus interest into 1 minus taxation. All over R, of course, we know that our R should be cost of what here? Somebody should be cost of equity. Our R should be cost of equity. R should be cost of equity. Now listen, there is a genius of a student in this room who has told me very fast, Mwalimu, that the other assumption of net income approach is that on a net income approach, taxation is always 0. And the net income approach, taxation is always 0. Taxation is always 0. And if taxation is always 0, and the net income approach, tax is 0, and therefore the present value then will be equal to the EBIT minus interest. Because taxation is 0, then 1 minus 0 is 1. All over who here? All over cost of who? All over cost of equity. All over cost of equity. But again, now remember, the net income belongs to who? The net income does not belong to the debt holders. The net income, this profit after tax, automatically belongs to equity holders. And that is why this present value, the whole of it, will go to value of equity. So you're saying there that, therefore, most importantly, the value of equity will be equal to, into bracket, we have EBIT minus interest, all over who? All over KE. So we want to know whether we are together up to there. Are we together up to there? Are we together up to there? Are we together up to there? Yes. Remember, profit after tax belongs to shareholders, ordinary shareholders. And the net income approach, if you can recall, there is another assumption that says that to finance this organization, we can either finance the organization through debt or what here? Equity. We don't have preference. So in this case here, there are only 2 financing vehicles. It is debt, stroke what here? Somebody, stroke equity. Right? It is debt stroke equity. So in this case here, the entire profit of the tax belongs to equity holders who are here. Value of equity is like that now. So then what I would expect somebody to do is to come and calculate the value of equity for farm A. Calculate the value of equity for farm A, of course, and the net income approach will only be required to remember the formula. Don't go through these monkey journeys that I've taken you guys with me. No, you are required. When the examiner mentions net income, you remember it's about discounting this indefinitely. And then, of course, whatever value you get there will belong to the equity holders, will be the value of equity holders. And if that is the case, then the value of equity for farm A, value of equity for A will be, value of equity for A will be equal to EBIT. EBIT is 2,000 minus interest. Interest, is there somebody who can tell me what I'm going to do to be able to get the interest of farm A? Is there anybody who can tell me what I'm going to do to get the interest of farm A? Farm A interest, what am I going to do to get interest of farm A? Do we have the percentage of debt? Yeah, it is 10% of the debt borrowed. It is 10% of 5,000. 10% of 5,000. All over cost of equity. All over cost of equity, which has been provided here. For farm A, the cost of equity is 0.12. All over cost of equity for farm A, this is 0.12. So could you kindly then give me the value of equity? Kindly give me the value of equity. So nasema, Alice anasema ni 12, is it 12,500? 12,500, thank you very much. And therefore, the value of the farm, value of the farm will be equal to value of equity plus value of debt, will be value of equity plus value of debt. So value of equity is given here. Value of equity, already we have it as 12,500 plus value of debt, which is what here? Which is 5,000. value of debt, which is 5,000. So then in total, the farm value will be 17 what year? Will be 17,500 like that. Will be 17,500 like that. Thank you. But unafaa kujua ile formula ingine, you always get students who confuse this thing. You always get students telling you, but mwalimu, value of a levered farm equals value of unlevered plus DT. Can somebody remind us, where do we normally find this formula? Where do we normally find that formula? Where do we find this formula of value of a levered farm equals under MM2 years? Under MM2 years. Thank you very much. Under MM2. Otherwise, in the other models, to get total value of the farm, you look at the support you're getting from equity holders. You look at the support you're getting from equity holders and the support you're getting from debt holders. The moment you put them together, you'll be able to know the total value of the organization. You'll be able to know the total value of the organization. You'll be able to know the total value of the organization. So that is farm A. How about farm boy? How about farm boy? How about farm boy? So for farm boy, ladies and gentlemen, for farm boy, farm B, to get value of equity, I know the formula. It is EBIT minus interest over cost of equity. So the EBIT here is 2,000. Interest, of course, I can see that the farm does not have any debt. The farm does not have any debt. So then the interest here will be 0. The interest will be 0 all over. The interest will be 0 all over the cost of equity, which will be what here? Somebody 0.12, which will end up giving us what figure? Somebody, which will end up giving us what figure? Somebody, which will end up giving us what figure? Somebody, 16,667. Thank you very much. 16,667. Thank you very much. And therefore, total value, the total value, remember total value is value of equity plus value of debt. It is 16,667 plus value of debt, which is what here? 0, which now will remain there. The other thing that I would want you great students of mine to appreciate, the other thing that I would want you students, great students of mine here to appreciate is this. The other thing that I would want you to appreciate as we get into this exam, you'll get a situation where this examiner will give you EBIT. The examiner will give you EBIT of a farm, perhaps it is 2,000. So they will go ahead and give you, for example, debt, talk of 5,000, and this happens to be a 10% what year? A 10% debt, 10% debt. And then what they will do, they'll go ahead and give you the RM. RM, perhaps they'll tell you that RM is 8%. No, it can't be 8%. RM perhaps is 15%. 15%. And then they'll go ahead and give you the debt to equity ratio. They'll tell you debt to equity ratio is 0.8. The debt to equity ratio is what year? Is 0.8. Is 0.8. And then what they will do, ladies and gentlemen, they'll go ahead and give you assets beta. They'll give you assets beta of 2.1. Assets beta of 2.1. Taxation. They'll go ahead and give you tax. They will give you tax of what year? Of 30%. They'll give you tax of 30%. They give you tax of 30%. Tax of 30%. Right? Quite a simple question. Quite a simple question. And then you'll be required here to determine farm value. Determine farm value using net income approach. Using the net income approach. Determine farm value using the net income approach. Let me give you 10 minutes. You try doing that question. Is there anybody who is able to pick any concept out of this question, really? I mean, there I can see so many low-hanging fruits. I can see so many. Yes, thank you very much, Karanja Gitonga. Thank you very much, Karanja Gitonga says that he has been able to see a low-hanging fruit in the name of Kapem, but it is not that low. Thank you, Nakaru Helen. They've been able to see something very interesting there. Thank you, Anne. So could you kindly go ahead? Yeah, somebody called MT has been able to see Hamada model. Has been able to see Hamada model. Those are low-hanging fruits. Actually, these are fruits. These are fruits, actually. These are fruits which are already on the ground. There's nothing like even harvesting. They're not even low-hanging. They are fruits already. Of course, whenever we go for harvesting, like when you are harvesting oranges, there'll always be those fruits which are on the ground. They're still good, fresh, on the ground. So it's like somebody did harvesting for you. So you ask basically is to, Karanja Getonga, I don't know what the risk-free rate is. So in this regard, I've seen a student who has tried giving me that formula of KEL equals KU. That one cannot apply here. Why? Because when you see them giving you assets beta, they want you to do some gearing. They want you to calculate Bell using Hamada's model. They want you to calculate whenever you see assets beta. These guys want you to calculate the Bell using Hamada's model. Is there anybody who can remember the Hamada's model? How do we write down? Can somebody write down this for us? The Hamada's model equals who? The Hamada's model equals who? The Hamada's model equals who? Hamada's model equals who? The Hamada's model. Thank you very much, Gitonga. Gitonga says, and Hamada's model, and Hamada's model, Bell equals Beu into 1 plus D over E into 1 minus what here? Tax. I really like that. Thank you very much. Anna has also been able to remember. So my Bell here will be equal to Beu. Beu is beta of equity over unlevered. Remember this unlevered beta. This is unlevered beta. This is unlevered beta. And the unlevered beta is the same as who? Is the same as assets beta. Unlevered beta is the same as assets beta. So has this examiner given me the assets beta? Has this examiner given me the assets beta? Has the examiner given me the assets beta? Has the examiner given me the assets beta? Yes, it's 2.1. It's here. It's 2.1. So 2.1 into 1 plus, do we have the debt to equity ratio? Do we have the debt to equity ratio? 0.8. Thank you very much. So 0.8 multiplied by 0.7. Multiplied by 0.7. Where have I gotten the 0.7 from? It is 1 minus taxation. It's 1 minus taxation. It is 1 minus taxation. It is 1 minus taxation. 1 minus 0.3. Thank you very much, DW. Dojvela. 0.7. Thank you very much. Great. So in that case here, then our Bell will be equal to who? I'm being told that our Bell by Nana will be 3 point. Our Bell, I'm being told here by Nana that our Bell will be 3.276. 3.2. Are we getting 3.276 or 3.1? Who is telling us the truth? Is it 3.1 or 3.276? I think Nana doesn't look like she can cheat. 3.276 is correct. Thank you very much. So having gotten Bell, now I can very easily, ladies and gentlemen, calculate the KEL. Now I can very easily calculate the KEL using CAPEM. I can very easily get KEL because first of all, we get Bell. And then now we calculate KEL. For the sake of the very new students, BEL stands for who? Beta equity of a levered organization. BEL stands for beta equity of a levered organization. After I get BEL, now I should be able to get KEL. Now I should be able to get KEL. Now I should be able to get KEL using CAPM. So come and get for us KEL using CAPM. So KEL using CAPM, to get KEL, ladies and gentlemen, we normally take risk-free into who? Into expected returns of the market minus risk-free multiplied by, in this particular case, BEL. I have to bring in the issue of BEL because they gave me the concept of assets beta. So I should not confuse. So if that is the case, then, ladies and gentlemen, my KEL here will be equal to risk-free. Risk-free, wanafunzi wengi wananiambia ati mwalimu ati hakuna risk-free. Is there anybody who is really telling us that risk-free is given? It is here. You can see even Mwangi has seen it. And this is something I've repeated severally. I don't know what I should do so that my students will be able to remember that risk-free rate of return, whenever it is not given in a question, risk-free rate of return, whenever it's not given in a question, it is always equal to interest rate. It is always equal to KD. It is always equal to KD. It is always equal to KD. Because remember nowadays, just go to a bank today. There is no bank that will give you debt without collateral. No bank will ever give you debt without security. So debts are what here? They are risk-free nowadays from the lender's perspective. So you're saying that somewhere there, that our risk-free rate of return is the same as KD. It's the same as KD. There is a student saying that my sound today is very low, which is very unfortunate. Is that the case for everybody? You guys are able to hear me? Are you able to hear me very well, or my sound for sure is very low? It's loud and clear. Loud and clear. Loud and clear. So perhaps the student who is saying that they cannot hear me, you need to log out. You need to log out and then you log back. You log back. You log back. You can see everyone else is happy. Is happy with my sound. Is happy with my sound. Is happy with my sound. So in that case here, then my KEL will be equal to risk-free. Risk-free is 10%. Plus ERM. ERM, ladies and gentlemen, expected return of the market. They have given this to me as 15%. So 15% minus risk-free. Risk-free, which happens to be 10%, into BEL. BEL that you and I got as 3.276, like that. Yeah. The question is here. We haven't even rubbed it. The question is here, it's not in the past paper. So is there anybody who is able to give me this value of KEL? Someone tells me it is 26.38. 26.38. Thank you and thank you very much. Thank you and thank you very much. So now once I have this cost of equity, I can now move with speed and calculate the value of equity as given by the net income approach. As given by the net income approach. As given by the net income approach. So as given by the net income approach, what do? Write down the formula first of all. 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 So my formula for net income, first of all, we get the value of equity. And to get the value of equity, we normally take EBIT minus interest divided by cost of equity. So remember the person who discovered this net income model. The net income model told us that even if you have taxes out there, use those taxes to do other computations, but not for value of equity. Value of equity gave us a model here expressed like that. In this case here, that doesn't have any tax. Doesn't have any tax. So don't come and tell me, but Mwalimu tax is 30%. I know. But you see, the net income model does not have provisions for tax. So therefore, the value of equity will be equal to EBIT. Are you able to see the EBIT? EBIT is 2,000 minus interest Interest. Is there anybody who is able to see the interest amount? Is there anybody who can help me with the interest amount? Is there anybody who can help me with the interest amount? Anybody who can help me with the interest amount? 500. Thank you very much. It is 10% of 5,000. 10% of 5,000 divided by the cost of equity, which unfortunately, cost of equity of this farm, which unfortunately I have deleted. 26.38%. 26.38%. So could you kindly come and give me the value of equity? Could you kindly give me the value of equity? Kindly give me the value of equity. So value of equity is 56.86. 56.86. 56.86. 56.86. 56.86. Thank you very much. Administrator has been very consistent in all my classes. Right? So after I get that 56.86, it doesn't stop there. The examiner wanted me to ascertain total farm value. The examiner wanted me to ascertain the total farm value. So total farm value will be value of equity plus value of debt. It will be 56.86 plus value of debt, which is 5,000. Which is 5,000, like that. 5,000. Or somebody is saying it is 56.86. I don't know whether that is the case. 56 point. I doubt. Remember, this is supposed to be 0 points. Please don't take this as 26.38 literally. This is supposed to be 0.2638. Right? So if that is the case, are we able to see 56.86 is a thing? Are we able to see 56.86 is the thing? 56.86. Right? Thank you very much. And therefore, the total farm value will be 10,686. Now, ladies and gentlemen, that is not even a bad examiner. No. A worse off examiner will give you the same information, but at the end of the day, they will come. At the end of the day, they'll come and calculate. They'll come and ask you to calculate. They'll come and ask you to calculate value of the farm. Value of the farm using NOI. Using NOI. What does NOI stand for in full? 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 A decimal place, of course, the more the decimal places, the better. Yeah, it's net operating income. When they mention the word net operating income, what comes to your mind? Net operating income is also known as who? Net operating income is also known as who? Net operating income. Net operating income. EBIT. It's EBIT. Net operating income is EBIT. Net operating income is EBIT. Net operating income is EBIT. When they talk of net operating income, NOI, this is the same as EBIT. EBIT. And therefore, here we'll be able to get the total farm value. Total farm value just with one stroke. You don't get value of equity first. You'll come and take here EBIT. You divide this by who? You take EBIT. You divide by W who? WACC. You are right. Because you see, EBIT is earnings for debt holders because we still have interest there. It is earnings for who? Equity holders. So this is a compound income. So also the cost of capital has to be compounded, has to be having the two elements, cost of equity and cost of debt, put together. We normally call them WACC. We normally call them WACC. WACC. Is that okay? Is that okay? Yes. So then I would want you guys to do me a favor. I don't have a problem whatsoever with EBIT, but I have every problem in calculations of WACC. I would want you guys to help me there. Please calculate WACC for me. Calculate WACC for me. Please calculate WACC for me. Very good, Abdi. Calculate WACC for me. I'm not hearing anybody speaking. So I want to see whether there is anybody who will be able to give me the WACC in this question. It's quite common. So Kibeti is saying 16.09, 16.09%. 16.09%. I'm waiting for one more suggestion. and then we move forward. And I'm so much impressed with this number, 70. Hey, why were you guys saying that you're not on leave? Why were you guys saying that you aren't on leave? 70. 71 now. Abdi says 17.85. The office, okay. So is there anyone else who has, okay, 17.85 seemingly is popular. 17.85 is popular. $17.85 is popular. Let me just give you one more minute. $17.77. So we can work this out together. So the very first low-hanging fruit, which I should just get to the ground and collect, is the weights. How do we get the weights? They have given us the debt to equity ratio is 0.8. So I'll come and give them the weight of debt. So to get weight of debt, remember, we normally take the number the way it is in the debt to equity over the same number plus who? Plus 1. Thank you very much, Juma. So you take the number, the debt to equity given here, over the debt to equity given there, plus 1. So then this will be 0.8 over 1.8. So 0.8 over 1.8 gives us what figure, somebody? 0.8 over 1.8 will give us what figure? Will give us 0.44. Thank you very much. Will give us 0.44. So how about weight of equity? How about weight of equity? So weight of equity will be 1 minus 0.44, which is 0.56, like that. Thank you very much. So having gotten weight of debt and weight of equity, then I'll come and remember very fast how we usually compute our WACC. How we usually compute our WACC. So to get WACC, we normally take weight of equity, cost of equity, plus weight of debt, cost of debt after taxation. So fortunately, this is a leveraged organization, and we happen to be having our CARE with us. CARE already, the cost of equity was calculated a long time ago. So the weight of equity here is 0.56 times cost of equity, which will be what here, somebody? Times cost of equity, which is 26.38%, plus weight of debt is 0.44 times cost of debt after taxation, then that will be what here, somebody? Will be 10%. 10% times 0.7. 10% times 0.7. Because you see, it's cost of debt after taxation. It's cost of debt after taxation. So you take the 10%, you multiply it with the adjusting tax rate, 1 minus T. So then, ladies and gentlemen, could you kindly give me this WACC? So somebody is telling me it's 17.85%. All the students who got 17.877, that is still okay. That is still okay. That is 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 okay. So after that, then somebody will come and remind my examiner that value, this is total value. The total value will be EBIT over WACC. Will be EBIT over WACC. EBIT over WACC. So then this will be EBIT. EBIT has been given to us. It is 2,000 all over 17.85 what year percent. 2,000 all over 17.85%. Let's see whether there is anybody who got this correct. 11204. 11204. 11204. 11204. 11204. 11204. 11204. Thank you and thank you very much. So let's get to our past papers and tackle one question there. We tackle one question here in our past papers, just one question. So there is this question of real estate finance, where they give us two properties. Is there somebody who has a revision kit who can go to real estate finance and look for a question there that has got two properties, A and B, whose values they wanted us to compute? Let's go to the topic called real estate finance and look for a question there. The last, you'll be able to see where real estate begins from, and then you'll be able to see, actually, I think it's even the first question up there, which has got two properties, and then they wanted us to value them using net income approach. Using net income approach, they wanted us to value them. Using net income approach, they want us to value them. Page number 197, November 2019, question 4B. Yes, it's November 2019, question number 4, boy. November 2019, question number 4, boy. Yes. So we have two properties there. We have property A, we have property B. Is there anybody who is able to see the EBIT? Is there anybody who is able to see the EBIT? Is there anybody who is able to see the EBIT? Is there anybody who is able to see the EBIT? EBIT. Is there anybody who is able to see the EBIT? Is there anybody who is able to see the EBIT given 41,245? 41,245. The EBIT there, I'm being told, is 41,245. 245,900. And I think that these earnings before interest and tax is the same for both properties. 41,245,900. Thank you very much. Right. Thank you very much. From the ladies and gentlemen, yeah, someone should be able to share that question on WhatsApp. Somebody should be able to share the question on WhatsApp. As that sharing is being done, is there anybody who is able, ladies and gentlemen, to tell us any other metrics that are given? Is there anybody who is able to see any other metric, like cost of equity, like whatever that is given there? Is there anybody who is able to see any other metrics which are given there? Any other metrics which are given there? Yeah, debt, 215 million. For which property? For which property? We have a 10% debt. 215 million for which property? Property B. Property B, 215 million. Property B. Thank you very much. Property A does not have any debt. Property A does not have any debt. Any other information that has been given to us regarding those two properties? Thank you very much, Doreen. Regarding those two property, cost of equity for both, 12%. So cost of equity for both, 12%, 12%. And then what do they need us to do? What do they need us to do? Required. What do they need us to do? What do they need us to do? What do they want us to do? What do they want us to do? What do they want us to do, somebody? Value using net income approach. So value using net income approach. So I'll give you exactly 10 minutes. You give me the answers. I'll give you exactly 10 minutes and then you give me the answers very fast, pretty fast, pretty fast, pretty fast. Give me the answers. Okay, so I can see what some student has given me there, which is pretty much correct. Which is pretty much correct, pretty much correct, pretty much correct. So can we do it together, or you guys are comfortable with that figure that has been given by most students? Should we do it together, or you guys are comfortable? I can see Neha has the figure. I can see Damaris has the figure. So long as you really appreciate the concept of net income, then automatically you are at home, resting. I've asked you whether we do it together or you guys are comfortable. Nobody is saying, Mwalimu, we do it. Nobody is saying, Mwalimu, we do it. Comfortable. 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 I'm okay. Okay, so ladies and gentlemen, the most important thing here is to appreciate the net income formula. The net income formula, net income formula. So the net income formula for getting value of equity, first of all, you start by giving us the value of equity. It is EBIT minus interest. And then whatever you get, you divide by cost of who? Cost of equity. So start straight away with project A. So project A, the value of equity will be equal to EBIT, which is 412, 45900 minus interest. I can see that interest here will be 0 because A is unlevered, doesn't have any debt, all over cost of equity. Cost of equity, which is 0.12. So whatever figure you'll be having here will be the value of equity as per the net income. Net income is this profit after taxation. Right? Right? You can see what Damaris has written there. Right? Right? So this is value of equity for farm what here, somebody? Farm A. And then whatever you get there, of course, you must come and add the debt, which is what is 0 for you to get total value, total farm value. How can we get somebody who has done this value of farm A? Please take a snapshot of that question and send it to our WhatsApp. Send it to our WhatsApp. Send it to our WhatsApp group. The solution to this. Send the solution to this to our WhatsApp. Send the solution to this to our WhatsApp. Is there anybody who has been able to do that? Is there anybody who has been able to do that? Anybody who has been able to send the solution to our WhatsApp? Anybody who has been able to send the solution to our WhatsApp? I would want to hear somebody saying there, yes, we can see it on WhatsApp. Yes, we can see it on WhatsApp, right? And then now we have value of B. So for value of B, of course, first of all, will come and give us value of equity. And the formula is not lost on us. We know it is this profit minus the interest rate, which is 10% of the debt amount, 10% of 215 million, all over the cost of equity, which is 0.12, all over the cost of equity, that is what here, somebody? 0.12, all over the cost of equity, which is 0.12, Cost of equity is 0.12. So could you kindly talk to me? What value of equity are we getting here? What value of equity are we getting here? Please talk to me. What figure of equity are we getting here? Whatever figure you will get here, call it XXX. To get total value of the farm, of the property, you'll take that XXX plus value of debt. So you'll take XXX here plus value of debt, which is 215 million. Please, for the ones who came in a little bit late, here we can't use that formula of saying that value of a levered farm equals value of an unlevered plus DT, because this one is normally applied under Modigliani Miller. And please help me out, because I would want to tackle serious questions here today. Please help me straight away by giving me the total answer, and send that answer that you have on WhatsApp. You must help me to preach this gospel. You must help me to preach the gospel. You must help me to preach the gospel. Great.